Hello everyone and happy Friday. Great day to be talking about estate planning, I guess. So today we're going to review some of the hot topics for estate planning, in particular give you an update on where we are from a law standpoint for estate tax purposes. If you've attended our webcast before, unfortunately maybe a lot of the information is the same. We really haven't had a lot of changes in the last year, but we do want to kind of just do a refresher on where we're at, what some of the techniques we're using today versus in the past, and kind of just refresh everybody's memory on how estate planning can work right now with the uncertain times. Unfortunately, I don't have any magic answers as far as what future changes will be, but we'll go through how that can impact your planning decisions. So where are we today? Well, as you may know, with the tax reform legislation that passed at the end of 2017, the lifetime exemption, or the amount that you can pass to family members without any estate tax, basically doubled from what it had been before. So for this year, the exemption is $11,400,000 per person. So a couple can transfer $22 million to family members without incurring any estate tax. The rate stayed the same, so anything over and above that exemption amount is taxed at 40% on a federal basis. The increased exemption applies for gift tax, estate tax, and generation skipping tax purposes. And that exemption for gift and estate tax is a cumulative exemption, so you use it either during your lifetime or at death. You don't have 11 million to use during lifetime and another 11 million at death, but you look at it cumulative. The GST exemption is also a one-time use, and we'll talk about that a little bit more later. The concept of portability came in a few years ago, roughly 2011, and that concept has not changed as part of tax reform, and we'll explain a little bit more what that means going in a little bit. The complicating part with the 2017 legislation is that the law under that bill does sunset in 2026, and that means that after 2025, the exemption will revert back to what it would have been under the old law. So that would be the $5 million adjusted for inflation, and we're thinking that based on what the inflation rates have been, the exemption in 2026 could be in that $6 to $6.5 million per person range. We won't know that until we get there. The other thing that is not part of tax reform, but just as a reminder, the 2019 annual exclusion, or the amount that you can give to an unlimited number of people without using your lifetime exemption, that is $15,000 per person this year. So a couple can give $30,000 without getting into their lifetime exemption. So as I said, the way the law is written today, there is a sunset in 2026. And as in past years, there's always lots of legislation that's being proposed or considered as far as changing the estate tax rules. And this year has been no different. This slide looks at a couple of the bills that were introduced this year in Congress. I'm not going to go through them in detail, but you can see that one significantly increases the estate tax by reducing the exemption and increasing the rates, and the other reduces the estate tax by reducing the rate. So depending on who's in power in Congress can determine what's going to happen. Another bill that was proposed this year, and this was part of making some tweaks to the tax reform legislation, this bill would accelerate when the sunset occurs for the estate tax provision, and that the exemption would go back to the $5 million level after 2022 rather than after 2025. So I guess the message that we want to have to our clients is that as of today, the exemption goes down in 2026, but it could change anytime before then also with legislation that comes before it. I mean, there's still bills that come in, candidates, maybe people that are promoting repeal of the estate tax, all of the way to, as you'll see, Bernie Sanders' provision that has the estate tax rate for very high net worth clients being 70%. So it's a big gamut. And this next year is going to be interesting to see what the candidate proposals are and where we see the election going, because if there is a change in, to the Democrats across the board, I think the odds of something changing in the near term increases significantly. Whether that actually happens or not, who knows? But just be aware there could be changes. So what are some of the things to consider with the uncertainty that we have right now? One of the things that we want to make clear, and that we get a lot of questions, confusion on, is we have clients that want to use that $11 million exemption before it, in case it goes down, I should say. And they're thinking all they have to do is gift the difference between what the lower exemption could be and what the higher exemption is, which is roughly $5 million. I'm going to give $5 million and use that exemption that might go away. And the problem is, or the concern is, that in order to use the $11 million, you need to give away $11 million, because your exemption, the gift is going to use up the lower part of that exemption first. So if you only give away $5 million and the exemption drops to $5 million, you have used up all of your lifetime exemption. You have not used up any of the part that goes away. So that is something to keep in mind. The other question that we had, even before this legislation, but that really came to light after 2017, was what happens if I give away the $11 million and I die when the exemption is $6 million? What happens to that exemption that I've used during my lifetime? Does that come back into the estate tax calculation, and do I have to pay tax on that? And the IRS has issued proposed regulations that say that no, that $5 million that you use during your lifetime, you will not, it ends up being part of the calculation in a way, but you will not end up paying tax on that amount. So we can, through planning, do the full $11 million gift and not worry about paying tax on that amount. So here's our first polling question. That's a true or false question, and it is the 2019 annual exclusion is $15,000 per person. Very good. The answer is true. So very good response on that. Now we're going to shift gears a little bit and just talk about some of the planning tools, techniques that we have available. And one of them that is a very important change that came about, again, 2011 roughly, is the concept of portability. And in my opinion, this has been a real game changer in the estate planning area. And what portability is, it's the ability to transfer one spouse's lifetime exemption to a surviving spouse. So I pass away and I give all my assets to my husband, and he's going to have a taxable estate. By filing an estate tax return, he will have not only his $11 million exemption, but he could have my $11 million exemption also. And how this was considered a game changer is that in the past, if both spouses needed to use their lifetime exemption, your plan had to provide for the use of that exemption on the first death. And I'll use smaller numbers because that's what they were when we didn't have portability. But let's say the exemption was $5 million and I needed to use my exemption at my death. I would need to own $5 million of property. that was not going to go to my spouse, and I would have to transfer that property into a trust or to my children rather than having it go directly to my spouse. And so you may have had a plan that included a provision for a family trust on the first death, or you may have a parent where there's a trust that was out there for that reason. And so the ability to pass that exemption over to a spouse has eliminated the requirement to be sure we're using the exemption on the first death. There are still very good reasons to do that, and that's part of the planning process still, but it has taken away some of that complexity from requiring it to be used on each death. So what is, some of the things to consider with portability, again, is it's taken away some of the required complexity, but it is somewhat, it hasn't necessarily made planning easier in that we now have to consider more the estate tax consequences for a plan and the income tax consequences. And the reason I say that is one thing that happens at death is that you have a step up in basis on all of the assets, well, most of the assets that you own at that time. So if I own stock in IBM, for example, and I paid $10 for it and it's worth $100 when I die, my basis is stepped up to $100. So when my children or my spouse sells it, there's no capital gain. And so by having the higher exemptions and portability, we're able to shift assets so you get the step up in basis at the first death, plus you can also get the step up in basis at the second death. And so coordinating the income tax planning and the estate tax planning has become more important. So what are some of the advantages of portability? One, like I've already mentioned, is simplicity, not being required to form some of those trusts that we had before. And again, the benefit of that opportunity to have the second step up in basis. We can also do a little more planning at the time of that first death than we could in the past. So decisions, we're wanting documents to be set up in a flexible manner so that decisions can be made after the first death rather than needing to make firm decisions, many years before the death. We can do some really good planning after that first death. What are the risks with portability? And I'd say the biggest risk is that an estate tax return does need to be filed in order to make that election and to have that carry over. So if I die and I don't even have any assets, but my husband wants to use or potentially wants to use my lifetime exemption, he still needs to file an estate tax return for me in a timely manner. And so that is one of the risks or costs associated with using portability. Another one is that for generation skipping tax purposes, that exemption is not portable. And what that is if you consider planning without the generation skipping, grandpa gives his pays estate tax, gives his assets to son, who again pays estate tax, and then it ultimately goes down to the grandchildren. Generation skipping is doing planning where grandpa puts assets into a trust that will ultimately go to the grandchildren, but the son could be a beneficiary of that trust and receive a benefit. The difference is that it's not subject to estate tax at that son's level. It's only going to be subject to estate tax again at the grandchild's level at a minimum. That exemption is not portable. So if you're wanting to do that with both spouses, you need to do some planning. You can still use portability and have that apply. It's just it needs to be built into the plan and be sure that's considered. Another factor with portability is that most states have not adopted portability. So if you reside in a state that has an estate tax, you'll need to consider how you use that state's exemption. I live in Fargo, North Dakota, so we're right on the border with Minnesota. Minnesota has an estate tax. The exemption is only 2.7 million per person. And so the planning needs to be, for a Minnesota resident, needs to be a little more complex because you need to be sure that you're taking advantage of that exemption on the first death. So we've talked about the higher exemptions that are available, and we've talked about the concept of portability, and what does all of that mean for what we refer to as a mid-sized estate. Like I said, you're not necessarily required to put assets into a family trust on the first death to take advantage of that exemption. So in the past, the planning has been pretty much that you did put assets into a trust at the first death and then have other assets go to a surviving spouse. And now you might want to consider having your plan changed so that you're using a disclaimer trust, for example, or a marital trust, so that you can decide at that first death whether or not you want to use the exemption at the first death or get that opportunity for the second step up in basis. And I don't know about those of you listening, but I like to use pictures because it helps me understand things sometimes. And so this is a very typical chart that has been used for ages, as long as I've been working in planning, which is quite a while. But in the past, what was labeled as that disclaimer family trust would have been something that was pretty much automatically funded with the exemption amount. And what the tweak is to the plan is that now, rather than automatically funding that trust, you maybe have assets going to the surviving spouse, and then he or she can disclaim assets into that disclaimer family trust. And again, the reason for that is to provide flexibility and allow decisions to be made at the time of that first death rather than upfront when you're putting your documents together. Some things to consider with that is that there are requirements as far as whether you can have an effective disclaimer. For example, the surviving spouse can't receive any benefit from those assets before they're disclaimed. And it also needs to be done within 9 months of that first spouse's death, which can be a very short period of time to make decisions. So it's something that you need to be aware that you have and be planning somewhat for is the fact that you do have that disclaimer and there are requirements. You can still have that family trust automatically created at the first death. An example where that is a very good idea is a second marriage situation where one spouse is wanting to make sure there are assets that ultimately go to his or her children. So a family trust can be a great tool to just fund right off the bat. And there can be provisions in that family trust so that we are basically going to have the opportunity for that second step up in basis. So there's lots of ways of doing the planning. The important thing to keep in mind is that, you know, building flexibility is always a good thing, and then, you know, really be monitoring what's going on. You don't want to do your will or estate plan and then let it sit for 20 years. So there are other things that you may want to consider doing because of the higher exemptions that we have now. The one thing to keep in mind is that if you are looking at some of these things that we're going to talk about in a minute, keep in mind that the exemption is 11 million today, but it may not be 11 million at the time of your death. So we always need to be aware of that potential drop in the exemption, and then also balancing the income tax and the estate tax considerations. So what are some of the things that you could do if you're not going to be subject to estate tax any longer? One of the planning techniques that we've used now for many years is the concept of the family limited partnership, or taking advantage of discounts. If you have, let's say you have a building worth $1 million and you put it into a family limited partnership, and each spouse owns 50% of that partnership, or maybe each spouse owns 45% and the kids own 10%. We have now reduced the value of that $1 million building to maybe $700,000 by the fact that we now have lack of control and lack of marketability discounts. Well, when you have those discounts apply, that $700,000 that I mentioned becomes the basis in that property after the death. It's not $1 million a basis, it's the $700,000 a basis. If you're not subject to estate tax anymore, then you'd really like that basis to be the $1 million rather than the $700,000. So there may be things that you want to do to not have the high discounts that we wanted in the past. Maybe changing ownership. If we made changes in ownership to take advantage of the discounts, maybe there's changes that you want to make to not have the discounts. If there was a family limited partnership that was created that isn't really needed for a lot of other purposes, do you want to just undo the family limited partnership if you can do it without a lot of income tax costs? There's trusts that were created years ago, the old family trusts, that maybe have an asset that has really appreciated in value. Because of the way they were structured at the time that it was created, there's no step up in basis, but maybe there's things that can be done with that trust so that there is a step up in basis at the time of the spouse beneficiary's death. So those are some of the things that can be considered, assuming that you're not going to have an estate tax liability even with the lower exemption amounts. Here's polling question number 2, and again, this is a true and false question. Does a federal estate tax return need to be filed in order to, well, a federal estate tax return does not need to be filed in order to have portability of the exemption, true or false? False is the right answer. Estate tax return does need to be filed to have portability apply. So we'll talk about life insurance for a minute. After that legislation passed in December of 2017, we had a lot of questions from clients regarding life insurance that had been purchased for the payment of estate tax liability. So maybe you had looked at having an estate tax before and you purchased life insurance to pay that tax. You had it owned by a life insurance trust so that it was out of the estate for estate tax purposes, because the last thing you want to do is buy life insurance to pay the tax and then pay tax on the life insurance. So we have a lot of these life insurance trusts out there that hold life insurance. And the question is, well, can I just get rid of the life insurance? And a couple of considerations to think about before you pull the trigger on that. One is, again, consider that the exemption could go down to, say, $6 million. So you may not have an estate tax today, but could you have an estate tax liability if the exemption goes down? So that is one of the considerations. Another is that you need to consider the terms of the trust, because just because you want to cancel that life insurance policy and maybe there's some cash value that goes in the trust, you still need to follow the terms of the trust as far as where that cash is going to go and when it can be distributed. For example, if you set up the trust, funded the trust, you're not a beneficiary of that trust, and that cash value isn't going to come back to you. And it may be a trust that the provisions are that it's going to be distributed after the surviving spouse's death. So you may not be able to immediately distribute cash to the kids either, unless you do some things with the trust provisions to make that happen. So just consider that life insurance as you're looking at your planning. What are some of the, so let's say that you're wanting to be using the $11 million exemption. You could have a estate tax even with that high exemption. What are some of the things you want to look at doing with it? And here's a list of some of the opportunities, and we'll go through some specific techniques in a minute. But you know, you may have had, let's say you're a closely held business owner and you gave some stock, you used your $5 million exemption by giving stock to the child that works in the business that you want to ultimately have own the business. And now you have this additional $6 million of exemption. If you have other children, maybe you want to do something to equalize what the other children didn't receive with the first gift. Maybe there's more of that business stock that you want to transfer to the business child, you know, considering that you're using that, getting that future appreciation out of your estate. Maybe there was you have a loan with a child to purchase stock, or with a trust that was set up before. You could look at forgiving the loan. There's just a lot of ideas on things that can be done, and this gives you kind of a starting point for that. So some of the components or things to think about as you're working on your estate plan to make sure that it's successful is really looking at your own objectives and goals. You know, sometimes when we're looking at things from an estate tax perspective, and sometimes we get caught up in the numbers and how you reduce your taxes, but you really need to make sure that any planning that you're doing really meets with your family's goals. Sometimes the best tax answer is not the best answer for your family, so keep that in mind. You know, we need to put the numbers to it, because sometimes in theory the plan may look great, but when you actually start putting your numbers, your assets into the picture, there's tweaking that needs to be done. Considering if you're looking at transitioning a business, you know, is there value enhancement that you want to consider? And if you do own a closely held business, you know, how are you going to transfer it? How are you going to make sure that the business continues if you're no longer involved? Are you transferring ownership to family members, or will it ultimately be sold? Those are all things that need to be considered as part of the estate planning process. You can't just look, if you have a closely held business, you really need to be bringing in that business succession at the same time. So again, just commenting that you do need to, you know, look at things to make sure that your goals are being met in the most tax effective manner. So for the remainder of the time, I'm going to go through 3 of the techniques that we use significantly for transferring assets, you know, for our high net worth clients. And we'll get into a few acronyms, so hopefully I don't get too carried away with that. But we'll go through the Spousal Lifetime Access Trust, the SLAT, and then the Grantor Retained Annuity Trust, the GRAT, and the sale to a grantor trust, which is a sale to an IDGIT, is how we refer to them. And for the most part, these are techniques which allow cash flow to come back to you as the grantor, but you're freezing the value for estate tax purposes, and maybe, especially with the SLAT, taking advantage of the higher exemption that we have today. So the Spousal Lifetime Access Trust is a trust where you can give away property, get it out of your estate, but still have potential access to cash flow. This was a very popular technique back in 2010, 11, and 12, when we thought the exemption was going to go down to $1 million. And I really think this technique is going to become more popular now as if we see the potential that the estate tax exemption is going to go down again. In this technique, what you do is you create a trust and transfer gift assets to that trust. And the trust is set up so that your spouse is a potential income beneficiary or principal beneficiary. And there's a wide variety of trust provisions that can be used, but it's a way of giving assets away, having them outside of your estate, like I said, but still having, through your spouse, access to that cash flow. So the cash flow is still in the household. It's just going through a different person. And then whatever's left at the end of the day, after your spouse's death, potentially your death, that ultimately goes to the children, however you're having your other assets go to them. So it's basically, the concept of this trust is basically creating that old family trust, the exemption trust during your lifetime. So you're using your, say your $11 million exemption now, rather than creating that trust at death. The trust agreement can provide for discretionary distributions to your spouse and descendants. It can have required distributions to your spouse or to your descendants. If you have an independent trustee, you can have very broad discretion on distributions. If you have more of a family member trustee, then you have to put some limitations around that so you don't have adverse estate tax consequences. One key thing to keep in mind is that any assets that go into that slat do not receive a step-up in basis on death. So if you have low basis assets, they're not going to have a step-up. Again, the spouse can have cash flow from that, and the trust is not included. One of the provisions that's out there that, in my opinion, you don't necessarily want to rely on, because I think we may get some adverse rulings at some point, but the theory is that, okay, I set up a trust for my husband, he has, the income, but at his death, he has the ability to appoint me as a new beneficiary of that trust. So basically, you can get the income back from that trust in the future. Like I said, that's something that today looks like it works, but I wouldn't go into this assuming that that is something that will automatically happen. The other thing, and this again became very popular back in 2012, was both spouses can create these trusts for the other. So I can create a trust for my husband, and he's the beneficiary. He can create a trust for me where I'm the beneficiary. Under the tax rules, those trusts can't be identical. So there needs to be different provisions in those trusts. We also don't want them to be created at exactly the same time, because the IRS can go in and look at it and say, you really haven't given up anything, because you gave to your spouse and your spouse gave right back to you. And so they basically ignore the transfers. So we like to have some time in between these, when these trusts are created. Also would be a good idea to have some different assets go into the trust. And this slide just gives you an idea of what some of the different powers or distribution provisions could be in the trust, so that they aren't identical. And this was actually some provisions that we used for trusts that were set up back in 2012. Now, some of the considerations to think about with this trust is, if we assume that that power of appointment of adding the spouse back in as a beneficiary doesn't work, once that spouse beneficiary dies, the person that created the trust loses access to the cash or those assets. So that's a consideration as far as who's creating the trust, who's the beneficiary, that type of thing. The other thing is what happens if the couple gets divorced. Technically, you've kind of lost access, the person creating the trust has lost access to the cash flow from that trust. So this is something that would not be recommended if you don't have a strong marriage and are concerned about divorce in the future. So here's the third polling question, and it's a multiple choice. What does the abbreviation ILET stand for? So that first answer is the right one, the Irrevocable Life Insurance Trust. Now we're going to talk about two techniques that have been used for a long time, for many years, and they're more of a leveraging technique, leveraging the use of the lifetime exemption, maybe rather than necessarily using a lot of the lifetime exemption. And they're the GRAT and the sale to the defective trust. They're very similar in some respects and also very different in others. And so we'll kind of do a review of both of them and then compare and contrast so that you can see the difference. With a GRAT, the grantor, the person setting up the trust, is going to transfer assets into that trust in exchange for an annuity. So a couple things to consider. With the grantor trust, and this also actually applies to the SLAT, something that I didn't mention, as a grantor trust, the person creating the trust is still taxed on the income earned by that trust. So let's say you have a closely held S Corp as a business, and you transfer S Corp shares into that trust. Grantor trust is now the owner of that stock. Any distributions from the S Corp for those shares will go into that grantor trust, and that cash is what is used to make the annual annuity payments. The grantor is going to include in his tax return the K1 from that S Corp, not the cash that has been received as the annuity payment, but the actual K1 income from the S Corp. So some cash flow planning needs to be part of the process of setting one of these up. The annuity payment is a fixed amount that needs to be paid on an annual basis, and that annuity payment is typically going to be equal, or the present value of the annuity payments is typically going to be equal to the value of the stock that goes into the trust plus an interest rate that the IRS sets on an annual basis. Right now, it's roughly 2%. The benefit of this technique is whatever growth you have in the company is going to ultimately fall to your children or the remainder interest. It's not going to be subject to estate tax as part of your estate. So you're getting that future appreciation out, plus the payment of the income tax liability is another basically tax-free gift to your children. One of the things that's very important in planning this is that if you happen to pass away during the term of the trust, those assets are going to be included back in your taxable estate. So if you're 80 years old, you probably don't want a 20-year GRAT because you're going to still have estate inclusion. That might be more appropriate for, say, a 50-year-old person, but you still have, the life happens type things. So you need to plan or consider that aspect of it. The alternate technique is the sale to the grantor trust, and you'll see that the diagram is very similar. But the differences are that rather than putting assets in and getting an annuity back, you are making a gift at some level to the trust and using part of your lifetime exemption. But for the additional stock or assets being transferred, you're getting an installment note back. So you're basically selling trust or selling assets to the trust. One thing, again, this is a grantor trust, so the grantor, the person setting it up, is still taxed on all of the income. And because of that, it's not treated as a sale for income tax purposes. And that would be the same with the GRAT too. You don't need to recognize any gain from the transfer of the stock, and you don't report the interest income as as an interest expense or interest income to the grantor. As I said, with the GRAT and the annuity payment, that is a fixed amount that needs to be paid every year. If you don't have cash in the trust to make the payment, you need to give some of the stock back. The installment note is can be a lot more flexible in that it could be interest only. I like to have some principal paid every year, but it could be, small payments in the first years with the balloon payment at the end. We can try and match the payments on the note with that estimated cash flow from the company. We've had some notes where we've used like a 9-year term on the note, but they've had extra cash going into the trust, so it was actually paid off in 7 years. There's a lot more flexibility. So if if you have a situation where the cash flow fluctuates, or the cash flow isn't going to be sufficient to make the GRAT payments, but you can make payments on a note, then this technique may be better than using the other technique. So here's some summaries on the advantages and disadvantages of each, and I'll just try and highlight a couple that we haven't talked about. Again, with the GRAT, we can zero out the gift, which is usually the desired result, so you're not using any of your lifetime exemption. If the IRS comes in and audits the funding of the GRAT and determines that the value was more than it was stated to be, it's self-correcting, so you still don't have any taxable gift. We generally like to use discounted assets when we're putting them into the GRAT or the sale to the defective trust. So another advantage of doing this technique is that discount value is ultimately going to the kids. A couple of the disadvantages, or a primary disadvantage, is the fact that if the client or you die during the term, that comes back in, the value comes back to your estate. Another one is that it's more difficult to use generation skipping with the GRAT than it is with the sale to the defective trust. One of the differences between the GRAT and the Eide is that the GRAT is how a GRAT works is set out in tax law. The sale to the defective trust is not, you can't go to a code section and find that. It's based on a lot of different tax principles. So if you're somebody that wants to make sure you're following the letter of the law, so to speak, then a GRAT may be more appropriate than the sale to the defective trust. We do have a gift element, like I said, in funding this trust. Generally, the rule of thumb, again, this isn't in law anywhere, but the rule of thumb is that 10% of the total value of the trust is going to be, or the total value of the stock or asset transferred is going to be the gift amount. We can do generation skipping with this technique, in that ultimately grandchildren or future generations can be the ultimate beneficiaries of this trust. Another thing that is available more with this technique than the GRAT is the power to substitute assets. So like I mentioned, assets that go into these trusts don't receive a step-up in basis at death. So maybe you have some low basis asset that went in there. You've really gotten the benefit of the appreciation, and now you want the step up in basis on that asset. You can substitute another asset into the trust and get that low basis stock back, so you can get the step up in basis. So there's a lot of planning that can be done. The other difference between the Eide and the GRAT is that if the grantor dies during that note term, or while that trust still exists, the value of the asset is not brought back into the estate. It's just the value or the balance remaining on the note that is the asset in the estate. So it's not an all or nothing as far as what comes back. So those are kind of quick descriptions of those techniques, but if you have any questions, want more details, definitely feel free to reach out to me. So what are a couple of the key points to consider from my talk today? One is consider the sunset provisions. We really don't know what the law is going to be going forward, but the way it is written today is that the exemption goes down in 2026. And because of some of the uncertainty and where the law is going to go and just the income, balancing the income tax and the estate tax, we'd like to see flexibility in the plan so that changes can be made down the road if the facts and circumstances change. And with that, we'll open it up for questions.
Okay. We do have one here. With a SLAC, can someone hold a limited power of appointment to get funds back to the grantor if ever needed?
Today, I would say that we think so. I know there's commentators out there that say that you can do that. If I was the IRS, that would be one thing that I would maybe look at. So I would be careful in doing that. But I know there's commentators out there that say that you can do that.
Okay. This one here says, what about Ocean's concept of floating spouse as the beneficiary of the SLAT? Any thoughts on that?
I do not have any thoughts on that.
Okay. That question was from Gary. And Gary, if you would like to email us, we can get some more detail on that question and maybe get you a better answer. Okay, this one's a little long here. The offspring of an aged client are comfortable financially and want to skip all or part of an inheritance via disclaiming. 4 buckets of assets: life insurance, real estate, brokerage, and IRA. Are there any pitfalls there?
The one thing with looking at a disclaimer is you need to be sure that the person doing the disclaiming can't direct where the property goes. So it's going to go to the parties that would have received if you were not living at the time of the death. So you want to make sure that the plan provides so the assets are going to go where you want them to go. The one thing that I would really look at closely is the IRA or the retirement account, because in a lot of cases, a contingent beneficiary is not named. So if you disclaim, it goes back to whatever the plan document says. And some documents that I've seen have that it's going to go to your children. Others have that it goes back to the estate. And so you're going to want to make sure that if you disclaim, property is going to go where you want it to go.
Okay. The last question we have here. In the past, Eide Bailey has offered a review service of documents for wills, trusts, and etc. Is this still a service?
Yes, it is still a service that we can do. Yes, just reach out to me. You've got my email information there. You can reach out to me and we will work that out.
All right. Well, at this time, there are no more questions. So thank you, Ramona, and thank you to everyone attending. And I hope you guys have a great weekend.
Thanks, everybody.